Welcome. On behalf of the team of 15 professionals at Paul R. Ried Financial Group, I want to extend a warm welcome to all of you to, I think, what's a very exciting and informative topic today. Our commitment from day one, and that goes back to 1986, has been to serve you with excellence and integrity, education being the hallmark of what we do. We started with Paul Ried Financial Services and moved into Paul Ried Financial Group. And then in 2018, we formalized that process and rolled out our PEAK, Planning, Education, Advice, and Consulting program. This is part of that program. Quarterly, our goal is to provide informative, topical webinars like this on planning topics such as Medicare, cybersecurity, Social Security, and obviously when things change in the economy and the market. So this is part of that process. We're excited to deliver this. Once again, a warm welcome to you as clients. I know we've got some relatives and friends. We now have an estimated 290 viewers actually on our webinar today from 18 different states. So it's a pleasure to welcome all of you. Our goal for each of you over the years that we've been serving you has been really to provide education, information to free you up from the worry of and concern about your finances so you can pursue the passions, interests, and desires that you have, whether you're near retirement, younger, or certainly whether you're in retirement. I want to thank you for your continued loyalty and commitment in that process. We're going to begin in just a moment. I think it's a very important topic, and we've got a panel format. So what we're going to see is we're going to see Adam Jordan, our Director of Investments, who's a principal of the firm, myself, and then Tim Kimmel, our Chief Financial Advisor and principal and great friend. So with that, let's go ahead, Tim. You'll begin the topic and you'll lead us through this topic. So thank you.
Yeah, thank you, Paul. And good morning, everybody. And thank you so much for taking time out of your Tuesday morning to spend with us. As Paul mentioned, this is a very interesting topic. There's a lot of misinformation out there that we're finding related to this big, beautiful tax bill, right? It's one of those things, right, where again, a lot to unpack. And so one of the things that we want to do, as Paul mentioned, is kind of give you relevant information that will obviously help. And as Paul mentioned, we're here for any of you that have questions, issues, and a lot of these things we'll typically unpack normally in our client sessions that we have individually with each one of you. But again, one of the things too that we're going to focus on today, as Paul mentioned, we've had these events for now. I think this is going on our third year. But today's session is going to be again on that tax bill that was passed July 4th of this year. It's called the One Big Beautiful Bill Act. And it is said, folks, that tax law is written in pencil, not in pen. And so one of the things that we have to be aware of is that every administration that comes in can obviously change the tax structure of things. So even though these are things that have, quote unquote, some have been made permanent, some of these changes, some are what I'll call temporary, just realize that things are always changing in the world of tax law and tax planning. And so again, part of our dedication is our service to you, and part of our educational approach is to obviously help you in some of these areas. Now, again, a couple of disclosures. We're not accountants, of course, so we don't want necessarily you to take this as tax advice. This is just relevant information that can help, again, with some of these questions that ultimately come out of these type of tax laws that get passed. But before we get too far along, right, some administrative things that I want to go over for our time today. As Paul mentioned, this is going to be a roundtable kind of format. So Adam, Paul, and I will be taking what we believe are the 10 most critical topics, if you will, really related to you, our clients. Rest assured, there's 870 pages in this tax law. So we're not going to get to all of it, of course. A lot of it has to do with businesses and, privately held companies. Just rest assured, if you know of anybody that has a business and needs help with some of these questions, refer them on to us. We're happy to talk to them. However, our time today is going to be spent more on the individual aspect of the bill, not necessarily the business aspect. And so Paul, Adam, and I will each take a couple of these and try to unpack them as best we can. Again, there's a lot of details, there's a lot of information, so we can't promise to get to all aspects of it, but we'll do our best to try to, again, clarify some of these things. Also part of our session today, generally these education events are about an hour long. We try our best to respect your time and to keep the event within that framework. Sometimes we might go a little bit over depending upon the amount of questions, because we want to make sure we try to get to as many of them as we can. There will be a Q&A session as well. So after we go through these 10 items, there will be Q&A. So again, there's an opportunity for you to ask any questions that you might have. If you're unfamiliar with the Q&A prompt, there's a tab at the bottom of the screen with Q&A on it, and you can just click on that, type in your question anytime during our event, and at the end, we'll collect them, and then we'll, like I said, do our best to get to as many as we can. If we can't get to all of them, one of our team members will reach out to you to try to address your question specifically, so just be aware of that. A couple of other quick administrative things. This is being recorded, so if you know of others, friends, family, colleagues that can benefit from this information, feel free to pass this along. This is really, again, designed for education and certainly for our clients, but also for others that you may know that could benefit from this. And then lastly, as I mentioned, one of the things that we're doing our best at is to have these particular topics. I know a lot of these can be politically charged. We're not going to get into the politics of all this. We're just going to deal with the information. But the reality is that, again, we'll do our best to make sense of all this for you. So with that said, let's kind of get into some of the topics. So first one I'm going to take, which is really kind of unpacking some of the income tax bracket changes that have occurred, as well as some of the standard deduction changes. And folks, to understand the tax bill, this big, beautiful tax bill that's been passed, we have to understand too that this is not standalone. This is actually built off of the original Tax Cuts and Job Act of 2017. Remember, President Trump passed in his first administration, or his first term, the initial 2017 Jobs Act cuts, or the Tax Cuts and Job Act benefits. And this just builds off of that. So realize that a lot of what we're going to talk about, at least I'm going to talk about, is that if this big, beautiful tax bill wouldn't have been passed, a lot of those benefits that the Tax Cuts and Job Act of 2017 would have sunset at the end of this year. And so, again, some of these things, theoretically, the big, beautiful tax bill have been made permanent. And one of the things that has been made permanent, if you will, is the federal income tax rates. So let me show you this. This is, you see this on the screen, but look, if you look at the left side of the screen, you'll see the where things were before the 2017 Tax Cuts and Job Act, right? So you see, I'm just going to highlight a couple of things. I don't want you to get lost in the numbers, but you see the tax rates go from 10% all the way up to 39.6. Okay. But then after, the Jobs Act cuts and 2017, what took place is that you see in the middle, realize these are the current rates. So 10% all the way down to 37. So you can notice that, hey, 39.6 bracket was taken away. And the 37 took its place. You can also see that the 15% rate went to 12, 25 went to 22, 28 went to 24, and so on and so forth. So realize that part of the original Tax Act of 2017 ultimately cut some taxes just based upon reduced tax rates at various brackets. Okay. Now, what the big, beautiful tax bill does, as I mentioned, is it just makes these tax cuts of 2017 more permanent that would have sunset. So, and you can kind of see some very modest changes related to the brackets of income that's allowed. So for instance, in the original 2017 bill, the 10% bracket went from 0 to 23,850. The big, beautiful tax bill takes it to 24,682. So very minor changes related to this, basically some very, I call it cost of living increases, really more than anything. But really more than anything, what this big, beautiful tax bill does is it prevents the tax rates from reverting back to where they were pre-2017. So that's really a very important aspect of this bill. Second thing is the standard deductions ultimately also have shifted and changed. So if you look at the second slide, you can kind of see where standard deductions now were before the original tax bill of 2017. So single filer, you could deduct $6,500. Married filing jointly, $13,000. But with the creation of the 2017 tax bill, those ultimately ballooned, right? So you see the tax rates for the single filer, the standard deductions went from $6,500 to $15,000. Now it was originally $13,000, but it's been increased for cost of living reasons. And then the married filing jointly went from $23,000 to $24,000, and then is increased to $30,000 with cost of living. Now, again, you can also see with the big, beautiful tax bill, those numbers have shifted ever so slightly, just up a little bit from 15,000 to 15,750 for single, and then 30 to 31,500 for married filing jointly. So again, the heart of this big, beautiful tax bill related to tax rates and standard deductions really doesn't change a lot from what we've experienced the last number of years to moving forward. That stays fairly intact. But what really the significance of this is again, simply put, it doesn't allow those tax rates to revert and the standard deduction rates to revert back to where they were pre-2017. So again, that's an important aspect of it. And again, one of the things that I wanted to address related to this bill, but I'm going to, Paul, hand it over to you for some of the state and local tax issues.
And thank you, Tim. Think about, this is that provision that's called the SALT provision. And SALT stands for, of course, state and local taxes. And what that really does, it means that there's a deduction for any state and local taxes we have. And what do those include? Well, in the state of Washington, it's property taxes, it's sales tax, income tax, if you're in an income tax state as well. And what there was before, just as Tim mentioned, with that prior to the 2017 Act, the Tax Cuts and Jobs Act, there was a limited amount of deductions. And of course, it benefited those folks in a high income tax state, but also benefited those folks in a high property tax state, which of course we are in the state of Washington. And if you have some extraordinary purchases, of course, it's sales tax. Well, in 2017, that was limited to $10,000. Now, what happened, you see the first bullet point there? What happened was that now is increased to $40,000. And by the way, this is if you're single or joint filers. So $40,000, so applies to both. There are some phase-out provisions, meaning that what you can do now, this is for itemizers, folks. So more of you may be able to itemize and take the standard deduction. We'll cover that a little bit later. But the point is, it increases the amount you can deduct, first of all, and it also then does apply to individual and joint filers. There are phase-outs, and what you'll see is a phase-out MAGI, that's modified adjusted gross income. So that phase-out begins at $250,000 of income for individuals, $500,000 for couples. What you see also is what the law provides is that SALT deduction increases by 1% per year. It does expire, by the way, in 2029. What you're going to learn is some of these are permanent and some are expired. So it's a little bit more complex. This is one that will expire. So in 2029, you can see the progression where it says SALT deduction limit and the phase outs over here. You'll see on this side. And of course, on the chart over here, it simply says that what you've got, I think this is significant, folks, is that whether you're single, head of household, or married filing jointly, it is all at 40,000. And of course, the phase out begins, and you can see it gradually goes down. That's the phase out. So then once you phase out, it then levels out at 10,000. Now, if you're married filing separately, it's half of that, 20,000. The phase out becomes earlier, and then that goes down to 5,000. So just be aware that that's something that's effective 2026 to 2029. That's something that's going to probably affect many of you. It may cause some of you to maybe change to an itemization versus standard deductions. So with that, Adam, why don't we move to tips and overtime?
Yeah, thanks, Paul. So these are kind of two different sections actually in the bill. So there's one is no tax on tips, and the other is called no tax on overtime. Now, the nuance here is that it's not actually no tax on either of those. It's no federal income tax on those things. Both of them do, both overtime and tips, even the ones that qualify, are subject to payroll taxes, so that's Social Security and Medicare taxes on those. So there are taxes, just no federal income taxes. Those are what are deductible. If we start with the no tax on tips, the max deduction amount is $25,000 of qualified tips. And again, this also has to do with this $25,000 amount is regardless of whether you file jointly or as a single filer. So you actually don't get a larger deduction max limit if you are married. You do, however, get a larger phase out limit. So your income phase out, both of these, the phase out for these starts at $150,000 for single filers and $300,000 for joint filers. It then phases out from there. Essentially, you'll have no benefit beyond $400,000 and no benefit beyond $550,000 for joint filers. So it has a slow phase out starting at those lower limits. One thing to be aware of, though, is that there's a lot of exclusions here, and we actually don't know all the occupations that it will apply to yet. They are to determine that by October. So 90 days after this bill was passed, they have to give a list of eligible occupations. And so right now they're just loosely defined as occupations that have traditionally and customarily received tips prior to 2025. Obviously, more and more jobs are, asking for tips and those sorts of things. So they also don't want people gaming the system and redefining regular pay as tips. And so there is a lot of nuance that goes into defining these things. There's also some occupations that do regularly get tips, but that are specifically excluded. And these are called specified service trade or businesses. These are most of them don't receive tips, but some we might think that do would be such as musicians and entertainers. They often do get tips, but they are specifically excluded from this, from our understanding of that. Also, it must be voluntary tips that you receive. So if we think about mandatory service charges, or what they call auto tips, those are actually specifically excluded from this. So it will be interesting to see how businesses go about maybe renaming those, or maybe trying to get it so that it seems like it's a voluntary tip, because there can't be a consequence for not tipping as well. So that's another key provision. And these all must be reported by the employer. So the tips must be reported by the employer as well. Overall, this starts in, so tips starting in, so even before this bill was passed, so it's retroactive to the start of 2025, and it expires at the end of 2028. This is a little bit because of who these jobs would apply to and how it's going to be defined. Early estimates are saying only about 3 to 4% of tax filers it will apply to. And this is also largely because, if you're below the income limit for the standard deduction, which a lot of tipped industries, maybe you're not hiring, maybe you're working part-time in those industries, this wouldn't help them anyway, because they're not making enough for that, so they wouldn't qualify. But about 3 and 4% of tax filers are estimated to be eligible for a benefit in regards to the no tax on tips. On the no tax on overtime, it's a little bit different. Again, you do get payroll. Payroll taxes still do apply here, but the maximum deductions are a little bit different. So it is different between married and single, or filing jointly. You have $25,000 for joint filers, and half of that, $12,500 max deduction for single or all other filers that are not jointly filing. The important thing about this and no tax on overtime is it only applies to the overtime extra pay. So imagine your regular pay is $20 an hour and you get $30 an hour for overtime, only that $10 extra is eligible for this deduction. So that's a big key point to be aware of. The phase out is similar as the tax on tips, but again, since the joint and single filers are different, the max income limits are different, but it starts at $150,000 for single filers and $300,000 for joint. And again, at $275,000 for single, you will have no benefit at that point, and $550,000 for joint. Again, we're throwing out a bunch of numbers here, but the key points are that remember that it's only relevant to the extra amount of the overtime, and also it only applies to federally overtime rules. So federal law about overtime. And so these are under the Fair Labor Standards Act. So generally think about this, hourly employees working over 40 hours a week, non-exempt workers. So things that wouldn't account are think about overtime pay from union contracts would not apply in this scenario. Also, overtime pay that's only required under state law would not count. So think about something like California has it where it's a daily overtime. So if you're over 8 hours, you're getting overtime pay. This is only so that would not count because the federal law does not require overtime pay for the over 8 hours, just over 40 hours in a week. So those are the main caveats about the overtime. This does apply to more people though than the tips. It's estimated that about 9% of filers will get some benefit from this. Again, obviously not close to the max because this 9% counts someone getting any benefit, but it does apply to more people, and it has the same beginning date, retroactively 2025, and ends in 2028.
Great, thank you, Adam. And yeah, next couple of things too, as Adam mentioned, everybody, there's a lot of numbers, a lot of data here, so it's easy to get lost in the numbers. But again, this is just a guide. This is just a template. And one thing too, I'll mention, and I'll mention it again at the end, is that we have prepared, in essence, a bit of a summary, if you will, of all of this that we'll be sending out to everybody after the event. So again, if you don't get it all, if you're taking notes feverishly, don't worry if you miss something. We'll try to, again, summarize it to some degree in this outline that we're going to be sending out to everybody just for your reference. So anyway, next up, also a big part of the changes in this bill is in relation to federal estate tax law. And so one of the provisions, again, think about what I mentioned earlier now, that this big, beautiful bill, in essence, is piggybacking upon Trump's original Tax Cuts and Job Act bill of 2017. So if you look at this chart that Emily put up, you can kind of see in 2017, this is the federal estate tax exclusion amount. So a little explanation there is that each one of us have an exclusion amount of assets that we could exempt from estate taxes. And that threshold in 2017 was almost $5.5 million, as you see. Now, a single individual, right, has 5.49 million. A married couple has double that, right? So again, if you have the right estate planning strategy, married couples obviously can double that exemption, or each one of us have that, I guess, is the point I'm making. But notice what happened with the Tax Cuts and Job Act of 2017. It ballooned that basic exclusion amount from 5.49 million to 11 million. Well, more or less doubled it. And then from there, you can kind of see the numbers increasing from 2019, 20, 2021, 22. It's increased with cost of living, right? And ultimately in 2025 today, right, that exclusion amount that each of us can exclude from estate taxes is now 13.9 million, almost 14 million. And again, single 13.99, married double that, okay? You can kind of see with the big, beautiful tax bill with the arrow there is that pretty much stays, it increases a little bit. Now it's 15 million and will be increased with cost of living, but more or less just kind of keeps on keeping on, right? The reality is that it just moves up marginally, not that much. So again, when you think about this big, beautiful tax bill, a lot has been made of it, but really what it does, again, is it doesn't change some of the basic formats that much. What it does do, again, is just keeps things from reverting back to where they would have if this wouldn't have passed. So again, just for the sake of, again, a bit of review, is that if the bill wouldn't have been passed, at the end of this year, the estate tax exclusion amount would have been reduced from 13.9 million back to roughly 5 or 6 million, right? So again, a fairly significant component of this bill is just making sure that these pieces, in essence, are quote unquote permanent. And again, remember what I mentioned too, is tax laws written in pencil, not pen. So again, permanent is only as long as this next, until the next administration kind of thing. The other thing too, which is again, a bit of a tangent, but I think it's important for everybody to realize, is not only is the federal estate tax threshold changing to some degree, or at least being made permanent, but the state of Washington also made some changes. And those changes, folks, went into effect July 1st of this year. So again, you can kind of see at the top, it says the exclusion amount for the state of Washington. Now, keep in mind a couple of things. I'll back up. Not every state has an inheritance tax. So there's federal estate taxes and state inheritance taxes potentially. Washington is one of those states that has an inheritance tax. So again, if you're in a state that doesn't have this, good for you. State of Washington, however, does. And that threshold prior to July 1st was 2.193. You see that kind of at the top left, if you will, where it says exclusion amount, 2,193,000. Well, effectively July 1st, with the new Washington state changes, is that exclusion amount ballooned from 2.193 over on the right now, top right, the exclusion amount's 3 million now. Okay, so again, families got a bump in the exclusion for Washington state inheritance tax. Now, again, not to belabor the numbers much, but you can kind of see that's nice. That's a nice change. But you also see something else that's a little bit maybe amiss with the numbers, is that you can kind of see again on the left column, on the left exclusion amounts. Notice that the amounts above those thresholds, 0 to $1 million, was taxed at 10%. So again, that's $1 million above that 2.193. But again, what I want to call your attention is the top. So again, if you were fortunate enough to have an estate that's above $9 million above that threshold, you would have paid under the old provision with Washington state a 20% inheritance tax on the amount above, again, that 2.1. So, okay, that's how it was. But obviously with the change that took effect July 1st, yes, we got an increase in the exclusion amount from 2.1 to 3 million. But notice again on the right columns there, you can see the tax rate now has ballooned for those higher wealth earners, if you will, to now 35%. So notice that 9 million number is 20 and now it's 35. So again, and it's increasing, exponentially. Really, the increase jumps pretty dramatically at, the 3 to 4 million range. So you think about, your investments, think about your house, think about other assets that you've accumulated. Again, it's not that difficult, right, to get into these layers, right, that are maybe above some of these thresholds. So again, important to know, not only is the big, beautiful tax bill shifting the federal estate tax picture, but the state of Washington also has made some changes as well. So think about it this way, and this is kind of hard to think about, but on the top end of the bracket, right, on the federal side, it's 40%, okay? And on the top end of the Washington state bracket, it's 35%. So theoretically, right, some of those, again, more fortunate folks that have larger estates, they could be dealing with as much of as a 75% tax hit on those amounts above those thresholds. So again, just important to know for planning purposes, of course. And again, just wanted to call your attention to not only the federal changes with the big, beautiful bill, but also with this inheritance tax and estate tax side. Also, the state has made some changes as well, which again is good planning. And again, these are things that we'll talk about in our planning sessions for those of you that are impacted to some degree. But again, this is important. So with that said, now I'm going to turn this back over to Paul to talk about some of the deductions for seniors.
Yeah, thank you, Tim. And hey, just excuse me, just a thought. I know we talk about inheritance tax. Think about that tax there's a difference between inheritance and estate. Estate really is a tax on the estate itself. Inheritance is a tax on the beneficiaries. So this actually is an estate tax. It can be synonymous in some ways, but that's just to clarify that as well. Think about the no tax on Social Security. Let me talk about that for a moment. This is probably one of the misnomers in the bill. You know, what we've chosen to call it is a bonus tax deduction for seniors, because that no tax on Social Security was certainly one of the big proponents of what this bill was all about during the compromise sessions. Then they, of course, compromise. It's obviously passed by the House, passed by the Senate, signed by the president. So let's really unpack what this bonus tax deduction is for seniors, because what you'll find out is you get it whether you are claiming Social Security or not. So this is one of those areas, if you think about it, folks, some of these, as Tim mentioned, are extensions of what is the current tax law with some modifications. This is really something new. So let's unpack this. First of all, let's talk about this current standard deduction, as Tim mentioned, is $15,750. It will be for single and $31,500. Now, y'all know if you do your taxes, and all of you do, there's an additional 65 plus enhanced deduction. Simply means if you're above 65 in the year you file your taxes, you get an additional $2,000 for individuals, additional $3,200 for couples. And that's what you see in the bullet point right there. Now, that's currently the way it is right now. So what's new about that? Well, the new is the 65 plus additional deduction, which we've just called a bonus deduction. So what's really going on, folks, is there's an additional $6,000 for individuals on top of the $15,750 on top of the $2,000. So what you're seeing in the first column over here is if you're single, now you get a total of $23,750. If you're a couple, it's double that, $12,000. So once again, married filing jointly, $12,000. Now there are phase out provisions. So the age 65 current, there's no phase out, just have to be 65. Under the new additional deduction, there is a phase out. And for individuals, it's adjusted gross income of $75,000 to $175,000. And you can see for couples, it's $150 to $250. Let me explain how that works. If you're a single individual, let's say your adjusted gross income is $100,000. So you're $25,000 over that $75,000. That doesn't mean you don't get the deduction, but it means you get a partial. And the way that works, again, into the weeds a little bit, is you take 6% of the amount above the 75. Of course, it would apply on different levels too, depending on if you're single or married and what the number is. But just as an example, we're $100,000 of modified adjusted gross income. You're single, and 75,000 is the beginning portion where the phase out begins. It completely phases out at 175. So at 100,000, you're $25,000 over that threshold. 6% of $25,000 is $1,500. So what's that mean? It means instead of the 6,000, which you would have gotten had your income been below 75, what you're now going to get is the 6,000 less the 1,500 or 4,500. So just know it's 6% of the dollars over the threshold that you see. So once again, you're still going to get the $2,000 enhanced deduction for over 65, still going to get the $3,200 for a couple. The 6,000 is what has this phase out threshold. And the neat part about that is, let me go to the other key provisions. First of all, to qualify, you need to be age 65 on or before year end in the tax filing year. Of course, it begins in 2026. So if you're 65 in 2026, you qualify, 65 or over. Now, interesting, there is no need to claim Social Security. So if you've decided you want to wait to your full retirement age at 67, or during our planning session, some of you we've talked about 67, some we've talked about 70. That's irrelevant as far as this goes. You just have to be 65 or over. And the other part that's kind of fascinating here is this applies whether you itemize or not. So the neat part about that again is it's for all tax filers, really. If you're 65 or over, itemized or not, does have a temporary effectiveness, and that's from tax year 2026 through tax year 2029. And you can see the potential enhanced deduction. And of course, we've profiled that right over here. Simply means if you're married filing jointly and there is one spouse over 65, the maximum of 39,100. Of course, once again, if you're single, it's 23,750. Both spouses are over 65. If you use the standard deduction, you get a standard deduction of 46,700. Now, what it's been right now, if you look at some of the research out there, only about 10% of the folks itemize right now of tax filers. So 90% take the standard deduction. So this is an area you want to carefully look at because once again, the 6,000 applies and the 12,000 whether you itemize or not, but think about some of the other provisions that Tim, Adam, and I have talked about. So again, this is something that we'll also, as we think through the planning sessions that we have, we'll be talking about. If you work with a CPA, this is a time, folks, when a CPA, if you're working with one, they should be able to dig into this on your behalf. We're here to give you kind of education, awareness, and suggest some information that might be relevant to you from a planning perspective. So Adam, why don't you continue with the next one, please?
Yeah, I wanted to, I'm going to touch on the new Trump accounts that we have that they've been labeled. The Trump accounts are a new type of account that are going to be automatically made for any newborns. So think about any newborns, and this is going to be retroactive to any child between 2025 and this sunsets in 2028. But any kids born during that time frame will have an automatic enrollment into a Trump account, and the government will contribute $1,000 actually. So this will not actually start. So the accounts, there's a lot of administrative work to be done on these accounts, obviously administratively. But the contributions are set to happen July 4th of 2026. So the bill says that it has a year from the enactment until contributing to these accounts. But that, again, that'll be retroactive to anyone born after January 1st, 2025. These accounts, though, great for that first 1,000. We do think there are likely other options that might be better, have better tax advantages long term, but I'll kind of talk through the way that these work. And a lot of it, once the child becomes 18, it functions actually a lot like a regular IRA account. So not a Roth account, but a regular IRA account. The difference, though, is that as contributions to an IRA are, tax deductible, contributions to the Trump accounts are not tax deductible. These contributions are made with after-tax dollars. The contribution limit is $5,000 a year. And the difference is you're making it with after-tax dollars like you would with a Roth, but when you take the money out, unlike a Roth, which the withdrawals are tax-free, all the earnings are tax-free, the earnings on the Trump account are actually taxed as ordinary income, similar to a regular IRA account. So it's going in after tax. Obviously, your contributions are not taxable again, though, because weren't able to make a deduction, but all the earnings will be taxed as ordinary income. Other caveats with this is that there can be no withdrawals made before the age of 18. So even versus a 529 account, you might have ways to even, certain states allow you to pay for K through 12 education. And actually that was actually something that was enhanced in this bill. The 529 accounts for K through 12 education, things like books and testing fees and things like that, or you can also use 529 accounts for that if your state allows it. But with these accounts, these Trump accounts, no withdrawals are allowed before age 18, obviously, except in the case of death. But Once the child turns 18, it becomes like an IRA account. So essentially there would be, before 59 and a half, there would be a 10% penalty for the withdrawals, and you would still owe ordinary income tax on any of those as well. There are some exceptions to that, similar to regular IRA accounts, like for first-time home purchases and things like that. First-time home purchases or education, you can have the withdrawals with no 10% penalty, but again, you do owe the regular ordinary income tax still on those. So the only way you're getting around the 10% penalty is either one of these limited situations or after 59 and a half. Other things to be aware of, I'd point out, is there's also limits on the investment options in these accounts. It's specifically limited in the text to mutual funds or ETFs with an expense ratio below 0.1%. And it must be only a U.S. equity focused index fund, similar to S&P 500. They specify a S&P 500 index fund in the text, but also mention that any other large, broad-based U.S. equity, so stock index fund would qualify. But again, it has to be below 0.1%. And so that definitely limits the types of indexes that would be in here. It also specifically excludes industry-specific indexes and things like that as well. So actually, there is already talks going on to try and expand these things, because it doesn't allow any types of bonds or anything like that. And obviously, as these things grow and people get older with these, they may want to change their allocation. But bonds are excluded from this, and it's equity only, US only index funds that can be used. Some other caveats here would be, obviously, we're not sure how. There's a lot of administrative sides, and there's some things written into the bill, though, was that employers can contribute up to $2,500 into these accounts. And it also gives some caveats for state and local governments to contribute separately. We're not sure how these would be used or in what cases, but I think they're giving leeway for maybe future tax legislation for states, maybe state-specific want to contribute to these sorts of accounts. But again, overall, I think there's a lot of other options to be used. Definitely the $1,000 is low-hanging fruit, take that. But then when it's anything beyond that, it might want to explore your other options as well, because as we know, and I mentioned earlier, 529 plans have become very flexible due to recent changes, not only the ones I just mentioned, but also 529 plans can be converted up to a certain limit. Roth 529 plans can be converted to Roth IRAs if the child does not use it for education expenses. So that's capped at $35,000 total, and it's about approximately $7,000 per year, up to $35,000 that you can convert from a 529 plan to a Roth. So that becomes very flexible, because obviously, the Roth accounts, just like the 529 plans, it's not the money's not taxable as ordinary income after the fact. So even it's debatable, even if you're talking about flexibility of types of accounts. Even the old UTMA, Unified Transfer to Minors Act sort of accounts, kind of brokerage accounts for minors. Even in that case, you get a little bit more flexibility, because your after-tax dollars it's after-tax dollars, just like the Trump accounts that are going into these, but it grows, and you're essentially just paying capital gains tax rates. Yeah, you have to pay some, any dividends and those sorts of things you'd obviously pay along the way, but you'd essentially take the money out for a lot more flexible reasons as well, and pay the lower capital gains tax rate. But a lot going on. The Trump accounts, new, again, not starting until July of next year, but something to be aware of. And again, it's auto enrollment, so these will be set up automatically, but details to come out more about the administration of them.
Very good. Thank you, Adam. Next is going to be a conversation, or I'm going to talk about the clean energy credits and some of the rollbacks related to that under the big, beautiful bill. So a couple of things just to, again, educate you on is that a lot of the electric vehicle and clean energy initiatives came out of the bill that President Biden passed called the Inflation Reduction Act of 2022. And so what this particular part of the big, beautiful tax bill is one of the only elements of tax increases that we're seeing actually on individuals, because again, one of the provisions of this bill is to repeal basically, or ultimately pull back on some of those credits that folks were getting for some of these reasons. So for instance, clean vehicle, right? Electric vehicle or something like that, you could have gotten up to, or you can still get up to $7,500 of credit on a new vehicle and $4,000 on a used vehicle. Now there's elements that ultimately, that allow you to qualify for that credit, but nonetheless, those are the thresholds right now. Those are set to terminate under the big, beautiful tax bill effective September 30th of this year. So again, if you purchase a car, obviously prior to that, well, meets the criteria, you can still get the credit up to that September 30th date. If you buy an electric vehicle, let's say on the 1st of October, don't have that credit any longer available. So that's a rollback. Another is refueling property credit. So what folks that maybe bought an electric car ultimately need a charger right at home. So there's equipment credits, if you will, that you can get by putting a charger in your home. That's up to $1,000 for that purpose. And again, that's also a credit that's going to be taken away effective June 30th. So again, there are various dates, which I don't know why they did it that way, but June 30th is when that credit is going away. Of 2026, that is. So again, the Clean Vehicle Act credits that are going to terminate, that's September 30th of this year, 25. The refueling property credit, the equipment piece, that ends in June 30th of 2026. So next year now. So another one is efficient home, energy efficient home improvement credit. You can get up to $1,200 on basically efficiency improvements, things like windows, doors, insulation, heating and cooling equipment. Again, those are going to be terminated effective December 31st at the end of this year, so 2025. And then lastly, there's a residential clean energy credit. For instance, installing solar panels, right? You can get up to 30% of the cost of purchasing an installation or installation. So it's 30% of cost of purchasing or installation of solar panels, wind power, geothermal, heat pumps, those kind of things. That in essence is set to expire December 31st of this year. So again, one of the increases as part of this bill is ultimately going to take away some of those credits for, again, for those of us that maybe are focusing on greener energy, clean vehicles, those kind of things. So again, that's a takeaway. And again, that's staged over time. Some September, some the end of the year, some June 30th of next year. I'll turn it over to Paul on the charitable allowances for standard deductions.
There you go. Thank you, Tim.
Yep.
The charitable giving provisions of the bill, let's talk about those. There are three provisions that we'd like you to understand. And by the way, these are for both itemizers and non-itemizers. So let's dig into this a little bit. First of all, there is a new charitable deduction for those that don't itemize. And this is meant to help, maybe it's helping the charities with smaller donations and so forth. But the point is, it's $1,000 for individual, $2,000 for a couple. So you can have a standard deduction. In other words, just like we talked about with the enhanced and the bonus age 65 plus if you qualify. And then you also get an enhanced deduction for $1,000 or $2,000 donation to a charity of your choice, 501c3. On this, there's no income phase out. Some of you may have what are called donor advised funds or charitable funds. Those are not eligible for that. So this has to be a direct charity, could be from Salvation Army, Union Gospel Mission, a church, whatever it might be. Those are all eligible. Now, this is one of those that is effective in tax year 2026 through tax year 2029. So once again, for non-itemizers, non-itemizers charitable deduction. But let's look at those of you who do itemize. They've changed this just a little bit, and let me go into this just a bit. First of all, the charitable deductions to qualify, or charitable contributions to qualify for deductions, need to be 0.5% of adjusted gross income. So 0.5% of adjusted gross income. So what happens is anything after 0.5% is deductible and reportable as gain. So in other words, if it's $100,000, 0.5%, if that's your income, is $500. So the first $500 is not deductible. Anything above that is. And then for those that make more significant contributions, there are some limits. And it's 60% of adjusted gross income. So so there is a maximum, by the way, you can deduct. You can't put all your income. 60% is the maximum you can deduct. There's also some of you, one of the strategies, by the way, it's still appropriate. If this is something that you want to consider, you can certainly talk to us at one of our meetings, is gifting appreciated stock. When you gift appreciated stock, what happens, of course, is you get a deduction for the full amount on your tax return. And of course, you don't pay capital gains tax. And the charities get the stock. And of course, their tax, there's no tax on charities distributions or contributions. So they don't pay tax either. So they don't lose as a government. But the point is, you can gift that, and that limit is 30%. You can carry forward for 5 years. So if you did contribute more than that, you can simply carry that forward for 5 years as well. This is one of those that's effective in 2026, so next year through 2029. So the biggest issue here, folks, is number one, for non-itemizers, you get up to $2,000 that is available for you to contribute, and you can not have to deduct. Previously, what happened was that folks that may have donated a modest amount didn't exceed the amount of the standard deduction. So in this case, you can donate a modest amount, and you certainly would be able to claim that as well. Think about the third item, and this is a tax credit for scholarship donations. This is one of the only ones I believe that's effective in 2027, and it's permanent. So what this provision provides is a $1,700 tax credit. So once again, different than a deduction. A deduction, of course, means it comes off of your income, so that deduction is equivalent to your marginal tax rate as far as a dollar value. The $1,700 comes off of your tax bill. So in other words, it's a true credit. So what that simply means is you can go ahead and to a qualified, it's called a qualified scholarship granting organization. And there are some rules that are still being finalized about this. One of the reasons I believe it's not effective in 2027, because the question is, and there's some regulations that have to be followed. I don't think they've sorted those out yet. But just recognize that is in the bill. It's going to be sorted out, more details to come on that. The whole idea is this is to support public and private schools. So once again, you deduct you provide $1,700. It's an immediate credit, so essentially it would cost you nothing, and that money goes directly to the school or educational institution of your choice. And of course, once again, that's permanent. And also, just as parenthetically, there are some other charitable opportunities. Are you familiar with probably the qualified charitable deduction? So for those of you that are retired and above 70 and a half, so once again, 73 from many of you is the date for the required minimum distribution, but that 70 and a half still stays in place. This is not necessarily in the bill, but it kept this provision in place for all of you. So if you're in the year you turn 70 and a half, you can actually pull money out of your IRA if you choose, and it goes directly to the charity, and you don't pay tax on it. And the way that's specified is actually it's up to $108,000. So for those of you that are very charitably oriented and want to explore that further, we can certainly talk about it at a future meeting, but just realize that's in place right now. So realize there is that qualified charitable deduction for RMDs that stays in place with this bill. In addition, you've got the charitable deduction for non-itemizers. You've got some limits for itemizers. And again, in 2027, you've got this credit for educational organizations. Go ahead and Adam.
Yeah, so I was gonna talk about the no tax on car loan interest provision. So this is similar to the no tax on tips and the no tax on overtime, is whether you itemize or not. And this is applies to for both whether you file jointly or single. It's a $10,000 max deduction, and it's for new cars with final assembly in the US. So there are caveats here. The new car with final assembly in the US, and that's a key thing because you can have, US brand cars like Ford that are technically made or final assembly takes place in Canada or Mexico, and these would not apply, that the car loans for them would not apply on these. And you counter to that, you could have maybe a Toyota that is final assembly in the US that would apply. So being aware of that, I suppose they are supposed to have the final assembly location on kind of the stickers. Also, you can do a VIN lookup online to see for that specific car type. So I'm sure that will become a bigger thing that people go out to seek. And another key is that it only applies to the interest portion of your car loan payment. So again, that $10,000 limit is kind of this artificial high that I think it would be very hard for someone to qualify for that $10,000 max deduction. Because if we think about, the average new car loan in the US is just over $40,000, about $42,000. The average interest payment currently on a new car loan is about 7%. And so that would equal about a $3,000 interest payment for the year. So you'd actually need a loan of over $140,000 at the current new loan rates to max out that $10,000 interest amount. And currently only about 1% of car loans have that. And on top of that, it has an income phase out. So the income phase out begins at $100,000 for single filers, $200,000 for joint. And it actually phases out quicker than some of these other things I talked about. And so it actually would completely phase out at $150,000 income for a single and $250,000 for joint. So really, if you think about it, to take advantage of that full $10,000, you would actually be buying a car that's more than your annual income, and you'd likely, one, you probably wouldn't qualify for that loan, but two, as your financial advisors, we might recommend against that. But if we take it in, though, there will be some benefit. Another thing is it accounts for any type of car, so it's actually also two-wheel. So motorcycles would qualify for this as well. Any street legal motorcycle would qualify for this as well. But another thing just to be aware of that goes along with these other aspects, might come up, but it does take some digging because the type of cars, it's not quite as obvious of the brand name. You need to look at where the final assembly was on these.
Great, thanks, Adam. And then the 10th item here with the big beautiful tax bill is related to the child tax credit. So one of the things that this provision does is, again, it makes that benefit permanent. Again, if the big beautiful bill wasn't going to be passed, the child tax credit would have reverted back to $1,000. Now it's $2,000. It's going to go up to basically $2,200 effective immediately this year. So one of the benefits for families, right, that ultimately get these tax child credits, they're going to get a little bit more relief. Again, the $2,200 for 2025 and beyond is basically for the first child, and then the second child is an additional $1,700. So it's not $2,200 each child; it's $2,200 for the first, $1,700 for the ones beyond that. And again, that also has phase outs. Single filer above 200,000 or married filing joint 400 get basically completely phased out of that. So again, a lot to unpack, right? Again, those are the 10 highlights really that we felt impact individuals. And so now we have kind of our Q&A session. So again, if you want to ask a question, just click on the Q&A tab, type in your question. Again, we're at 11 o'clock right now. So again, I want to respect your time, but if for those of us that maybe have a little time, I want to kind of go a little bit further into this, maybe another 5 or 10 minutes. If you have to go, that's fine too, but I want to try to get to some of these questions that are coming in. So I'll start with a few questions that have come in already. Adam, I'm going to pose this one to you. So again, a lot of things related to the big, beautiful tax bill. One of which is, hey, these tax cuts made more permanent, new things coming in. So Adam, what do you think? What do you think the impact of this is going to be on the debt and deficit? And your perspective on, hey, is this going to impact the stock market?
Yeah, I mean, it's definitely going to add to the deficit. I mean, I believe we've seen various numbers where it's 3 trillion. I mean, it's all estimates because it's based on, growth rate that comes out of this. So it's, but there's definitely a deficit being added to this, which is interesting thing to prepare for, because obviously there's a lot of rolling over of the debt currently. So the markets so far have handled this pretty well. There wasn't a dramatic reaction in the interest rate environment. But again, as we keep delaying and kind of pushing the can down the road on these things, it's definitely an area that we need to pay attention to, both in the bond market and the stock market, because as more debt is issued, more money needs to, be invested in the bond area, which could take away capital from supporting the stock market as well.
So Paul, I'll turn to you now. So this is a question comes from Terry. It says, though it is not in the current tax bill, the administration Congress has proposed possible changes to capital gain deductions and also capital gains related to residential real estate from the current 500,000. So just a little clarification there. Individuals have $250,000 exemption from capital gains taxes on the sale of their primary residence. Again, that's doubled for married. So 500,000 would be applied to a married couple as it relates to selling of your primary residence. So do you have any thoughts on these proposals that may be moving forward? Any thoughts on any of that?
One thing that's very interesting, I think, is what this new bill touched and what didn't touch. I mean, if you think about it, this had to go through, even though it seems to be passed and signed in pretty short order. There's a lot of discussion, a lot of compromise that occurred behind the scenes we don't know about. So one hopeful sign is what they left untouched, and I feel really good about that. Has there been any talk about the exemption for primary residence? As I do the reading, Tim, and the research, there has not been. So I feel pretty good that that's going to stay in place. Obviously, we don't know, but there were some compromises, things that were touched, things that weren't touched, and this is obviously a result of all that. So I feel good about kind of still having as a planning horizon. If you're thinking about selling your house and taking advantage of that, I wouldn't necessarily feel you have to do it in short order, other than what your plan as you talk to your advisor might indicate.
Sure. So Hugh, another question Hugh asks is related to the new tax brackets indicated in years 2026 and beyond. Do the rates apply to the 2025 tax return to be filled out in 2026? So my understanding, Hugh, is that the big, beautiful tax bill, there's going to be components that are going to be effective this year, components that will be effective ultimately in 2026 tax year, which then you'll do your 2026 returns in 27. So my understanding is the rate increases ultimately will go into effect next year, 2026. But other things like the tax credits and the SALT deductions and those kind of things will be pulled into this year, 2025.
So the brackets though are going to be on your next year's taxes.
Yes, right. That'll be effective for 2026, which you'll do your return in 27. Exactly. Yeah. Paul, I'll go back to you for a second. It says the Social Security deduction, that's $6,000 for old folks over 65. Do you know if that applies to gross income or taxable income? I guess so. Adjusted gross or taxable income?
Boy, I guess I'm unclear on that one at this point. I would say and I'll throw it open to you, Adam and Tim.
Yeah, I think my understanding is, I think it's adjusted gross income.
Yeah, I think it's adjusted gross as well. So part,
Yeah.
part of what you're seeing, folks, is, we're here to, it's so interesting as we crafted this class, we were actually talked to several accountants and they said, "Are you sure you want to do this? Because there's a lot of uncertainties out there right now." And we said, "Yeah, we want to get this information out." So we're really very clear what we know, what is still under it's still being researched and still being implemented, and also what we don't know. So
Yeah.
just remember, as Tim mentioned, the disclosures are, this is designed for information. You want to seek advice from your accountant, specifically if you're working with one. And obviously, we're incorporating this in all the planning that we do. So thanks, Tim.
Yep. So let's see here. Another question's come in from Art Haynes. And this, Adam, I'll apply to you. It's Art asks, is there any substantive changes to Social Security or Medicare in the big beautiful bill?
For Social Security, not that I'm aware of. There's no change to the calculations. There's obviously this thing not associated with Social Security, which is the above 65 situation, but that's whether you take Social Security or not. Other than that, there's no real impact except for the idea of people are like the fact that this is adding to debt, whether this puts strain on the Social Security system. But other than that, not that I am aware of any changes directly to the benefits you get.
Yeah, that's great. And then one last question before we kind of close it up is that, and again, I'll open it all to you, says, are the current tariff policies that are being presented and in place, obviously since August 1st, is there connection between the tariff policies and Trump's big beautiful tax bill? Are they interrelated at all, do you think?
It's an opinion, of course. One thing that's kind of interesting about the tariff policies, the markets have digested those really, really well. And if you think about the disruptions that occur, this is kind of a broader basis, the disruptions that have occurred, disruptions obviously in some of the policy uncertainties in Washington, D.C. We've got tariff issues. We've got this big, beautiful bill. As we've all talked about, and when you've worked with all of us, we said, hey, markets don't like uncertainty, tremendous amount of uncertainty, yet the markets still seem to be pretty resilient. I'm not suggesting that's the way it will be for the future, but is there a connection? Not that I can see, but obviously there, in a strange sort of way, I think investors are hoping there is some kind of a master plan that's coming together, and it remains to be seen. But I can tell you, without knowing that the markets have digested this really well. And seemingly it's embraced as something that's positive overall economically, keeping politics out of it.
Great. Well, thank you, Paul and Adam, and great information. And again, folks, just to remind you that, again, Paul mentioned it as well, but again, this is just informational. One of the things that we are going to do is this is recorded. We are going to have it replayed. So again, for those folks that maybe you feel like, hey, could benefit from some of this information, family, friends, colleagues, folks that you know, please share this, and we will send out generally a link with the information, and it'll also be posted to our website. So again, if by chance you know folks, pass this information along. Again, we generally will send out an email with the link. The other thing too, just to mention, and I mentioned it earlier, but just to remind you, we are going to be sending out at the end of the day kind of a summary of all the things that we've been talking about and things, again, that we believe are most pertinent to your financial picture. So that's kind of our gift to you, if you will, again, just to try to unpack a lot of these things. And to Paul's point, there's a lot of facets, a lot of moving parts to this. And again, we just touched again on the individual side, not the business side. So again, if you know of any business owners that they want to kind of unpack some of this on that layer, we're happy to help them as well. So thank you so much, everybody. I know we went a little bit over time, but wanted to make sure you got the information. Our next events, again, we want to invite you to. You'll be getting invitations here probably in a couple of months out, but this is our November 5th event, our live event up at Newcastle Country Club. And so we'd love for you, as many of you that are in the Seattle area, to attend. Also, just a note, we do have that recorded. And so for folks that are listening from other states, we will have that replayed as well. So thank you so much again for your time. And appreciate you joining us. And we're thrilled that these education events are gaining more and more popularity and more people are signing up. Again, we do our best to try to make sure this information is pertinent, timely, and obviously on topics that we think you will enjoy. So thank you so much for your time. Appreciate you and ultimately your confidence and trust in Paul Ried Financial Group. And with that, have a beautiful day and enjoy this great weather we're having. Take care. Bye-bye.
Take care.